Good evening, traders. Today is December 27, Friday, and we will talk about market and our portfolio again. So, if you remember, let's talk about market first. If you remember, we at the end of last week had a big drop of market, approximately 200 points. But the most important thing, VIX went up from approximately 14 to 26 at some point. So it's two times. Our portfolio uh, was down approximately 6% during that event. But this week, markets start bouncing up, go up to 6,100 on ES futures. We got all our losses back, and even my portfolio was probably 0.5% higher than before that market collapse. But today, unfortunately, market went down again, so it's approximately 100 points, and VIX went up from about 15 to 17, to more than 2 points. Uh, let's see how our portfolio look like and how our position look like right now. If you remember last week, we rolled down lots of our short puts, which reached rolling point at delta 20, roll them back to delta 10 and pay for that with our hedges. Uh, when market bounce up, I just would like to mention that it's important. We don't know. Maybe it's starting of new bear market, so it could be another leg down. So when after this big event market bounce up, you should restore power of your hedges. How we do that? We're probably looking for closing some shorts, cheap shorts of our delta hedges or vertical hedges, and try to restore that hedging power to be ready for another leg down. Okay, let's see. By the way, today after market dive 1%, our portfolio down approximately 1%. How you can see that usually we have the biggest decline of our net leak during the first event when VIX is going from low to high. Second uh, leg down, it's usually not so dangerous from profit point of view. I mean, not profit, but net leak reduction. So right now we have all our, as usual, I show you on my OptionNet Explorer, all our position of together of ES futures. Uh, Total portfolio delta right now about, it show in OptionNet Explorer about 37. It's SPX, so it's 370 of SPY. If you remember, our portfolio approximately $200,000 in size, so we are close to 0.2% of portfolio size. So is it big? No, not necessary. Just because IV expanded again. So we usually pretty comfortable with delta from zero point 0.1 to 0.2. Even we can handle it until 0.3. After that, we will start thinking how to reduce our portfolio delta. Usually we add ratio hedge. We can add a couple of more vertical hedges if we need. Now let's see how our position look like now if we separate them. The first one is a ladder. Well, it's not bad. Our shorts is at delta 7.5 and it's 35 days till expiration. I think it's pretty safe unless we get huge decline again. Ladder B is right now delta 2.5, also quite safe. Our short puts right now at 33 days till expiration. Let's see where its delta is. Delta about 7, so also quite safe. I don't see any problems here. Ladder C has a delta about 4. Our shorts at 42 DTE also at delta 7. I don't see very much problems here. Ladder D is a little bit, because we did roll it the last one during when market was toppy, and right now it's has a little bit higher delta, about 5.3. Again, we're talking about SPX delta here, and our short puts at 42 DTE at delta 10.4. I don't see much problems even here, so we'll see what's gonna happen. Also, we have our balalaika trade, which is that's how it's looked like. Delta is reasonable, just 3. Our short put, closest short put is at 35 DTE, approximately delta 6, and the second one is at 56 DTE at delta 8.6. So plus we have pretty good hedges here. We have 2 longs and 1 vertical hedge. So altogether we have extra vertical hedge, which we still have. We had 3 of them. We spent 2 for rolling our shorts. Now we have 1 extra. You can use it for something else. For example, I remember we had Vega hedge, and if you open 30 DT short put to pay for that delta hedge to make it in credit, and it will be under pressure, you can use that vertical hedge partially by, let's say, roll down long for 100 or 200 points and roll that 30 DT short put at delta 20 to delta 10 or 12, maybe same expiration or a little bit one or 2 weeks longer. Also we have violins. Violin 6 is in pretty good shape right now. Violin 5, if you remember, we closed yesterday with good profit, approximately $1,200 if I remember correctly. And at the same time we open new one, V7. Let's see V6 first. We have short puts at 35 DTE at delta 7.7. We still have 500 wide our delta hedge, so we will wait next week. If delta will be of short puts reduced to around 5, we can, as usual, roll down our long puts 100 points to increase our profitability. And let's see our V7, which we opened just yesterday. It's in small loss right now, about less than $200. Again, because market dive and VIX increase. But I don't see much problem here. We will see how it's developed. Usually, violin is it's not so volatile trade. We have violin mini 1, which we converted, if you remember, to hedge, and right now it's at positive $400, and you can see that it's no lose upside, so we're gonna keep it. By the way, it's another option to close it if you need it for rolling your short put of Vega hedge. It's up to you. You can choose any of them. And we have VM2, which we convert to regular violins. So right now we have 1, 2, 3, 4 violins, right? So let me see how many we have. No, we have V6, V7, and VM2. So we have 3 violins altogether. So it's in good profit after market bounce up. It was a little bit higher yesterday, about $1,000. Right now it's $850. We're gonna continue to hold it, and but if you have by the way, if you have a margin issue, you can close it. It's up to you. Now let's talk about our MES strategy. I remember that last week I forgot to show it. Let's see how it's look like now. So we have 2 tranches. One of them already 46 days old, and it's 35 DTE left. It's in very good condition. We approaching our tail profit, and we will start probably next week or so, if market won't collapse, start closing our lowest short puts. This one 5,350 strike. It's a delta 5. We start closing them if it drop from 9.5, probably somewhere in 5 area. So we'll close them and hold longs, which will continue to protect our next tranche, which is 18 days old and is 56 DTE. It's also in profit. If you remember, when it was a big market decline, we did first adjustment. We closed 2 our shorts and opened 3, so it's 2-to-3 ratio roll. Now we have it pretty far. Here it's the closest. We have 1 short which left, and we have 5,500 strike. First short, 3 shorts, and that one which we roll down, it's at 5,400. So it's in good condition. And also, if we close short puts of our other tranche, that structure will protect us even better. We will have additional protection for this tranche, and probably on Monday we will add to it. We will see how market gonna behave. Also, we have a oil position. It's just one ratio, 1 to 3, 17 days old. It is 49 days till expiration, about $200 in profit. Market stay in same range. No, sorry, it's 350 in profit. So I don't know, maybe another week or two, if we approach that tail line, we will close it and open new one. We have one position which unfortunately in loss. It's our TLT position. If you remember, TLT dropped down so far. It's approximately right now at 87, 87.2 right now. So it's pretty big dive. But I don't worry about this, because at this level I don't mind to own TLT as a stock. It's paying more than 5% dividends right now. And I doubt that it will drop too much further. So, and we will continue to sell calls and puts against that long 200 shares and make it a little bit more profitable than 5%, probably 10 or even higher. So far, it's I don't worry much about this position. I did it just to have some kind of addition of to my bill position, which paying about right now 4%, I believe, dividends per year. TLT can make 5, plus we can sell options against it. So I hope we're gonna make money from this trade sooner or later. That's it for market. Let's talk about. Let's see what kind of questions do you have, guys. I saw that you have a couple of them. Questions. Yeah, Bob asking, could you please discuss how to keep portfolio delta in the 0.1, 0.3 range? What specifically would you recommend? Mine is always too low. I try not to deviate from your recommendations on rolling and adding trades, but I do miss some things. Well, first of all, to keep we don't need to keep our portfolio delta 0.3. 0.3, it's actually a little bit too high. We're trying always steer it to 0.1 position in 0.1% of our total portfolio. How we do that? First of all, I know, guys, when you roll your short puts, you're trying to be a little bit more safer and probably do it instead of delta 10, you roll it to delta 8 or 7 or something like that. It will reduce your portfolio delta. Try to roll it to delta 10, and if you have your portfolio delta too low, close to zero, I would start to check what is lowest delta short put you have, and probably will roll it a little bit higher just to increase portfolio delta. Roll it higher to the same expiration, or if it's time, just you can do your roll to next expiration, lift it up to delta 10, and this way we should keep our delta around 0.1%. Also, you can probably reduce a little bit your hedge by rolling down some longs if you need to. I'm not recommending this, because I prefer to hold our hedges. You know that someday it will save us, so try to touch it. It was the last tool to increase my portfolio delta. Better just to deal with short puts. Another question, maybe I have missed it, but could you explain how we could effectively manage the leftover of PDS from ladder range? What is the preferred ratio on the PDS to naked put for the whole portfolio? This also applied to the delta hedge we have currently, exclude the one with violin. No, you use delta of portfolio to gauge, but how could we manage it more efficiently to reduce the cost of the hedge? Very good question. First of all, how we're gonna manage our PDCs, which is leftovers. I don't touch them, guys, because even they're cheap. If market collapse, it will help us a lot. If not, just leave it them to expire worthless. It's not a big deal. So just hold them. Second, what my preferred ratio of PDS to naked puts? Well, I would like to have at least 1-to-1 with good old, not old, new, more than 90 DTE vertical hedges or equivalent of that. Let's say that if you have just long puts from Balalaika, you can count them as a 2 with coefficient of 2. So that's what I prefer. I would like to have more than 90 DTE hedges, at least 1-to-1 to my naked puts. Plus, probably the same amount, cheap old one, leftovers, how you name it. And by the way, if it's leftovers, just you probably at some point when shorts of that leftovers will be very inexpensive, you can close them and just keep long puts. It will be very good addition to Vega protection. Plus it will be good delta hedge if market collapse, let's say 20%. So keep them. I would like to have at least one more this cheap delta hedges or vertical hedges to my naked put. So altogether, I prefer that I'm gonna have 2 of them, 2 hedges to 1 naked put. How we manage them to make them less expensive? I already discussed it. I remember previous time. So when VIX is high, to make our hedges much less expensive, better probably to open it as a delta hedge. This way, we can open 2 delta hedges, which is 4 longs, 6 shorts, probably at the same price as 1 vertical hedge. It's maybe it's not as strong as a vertical hedge, but sometimes in the future, if market bounce up and sometimes decay, we will close that short puts much cheaper than we sell them, and make that vertical hedges big and much more efficient, and it will be better. And vice versa. If VIX is very low, I start looking for closing my short puts of my old vertical hedges or delta hedges to make them stronger. Why not to do that if it's cheap? Yes, you pay for this, but it's much less than you sold it before, and you improving your hedging, and at this point you can be a little bit more aggressive with your short puts. I mean, from income part of our strategies. This is how I manage them. But again, do you have to do it? Probably not. You can do our standard way as we discuss it in each our strategy. Just hold them till expiration. Roll them when you need to roll to pay for rolling of naked puts. Uh, same as you did before. But if you want just to make it little bit better, yeah, you can use VIX to change it a little bit. Uh, Fortunately, VIX is much more predictable than market price. So if VIX is high, why not to use it for hedges and vice versa? That's it. I don't have any more questions. Thank you very much, guys. Have a nice weekend and happy new year. I hope you had pretty good Christmas with your family and stay safe. I hope everything gonna be fine. We won't get a second leg and at least till middle of January. And our short puts will pay it off very well. And after that, when we roll our short puts, we increase more our hedges and be prepared for uh, bear market if it happened. Thank you very much. Bye bye.